some comments from bond market participants as well on this. We've got Lakshmi Iyer from Kotak Mahindra AMC, as well as Ashhish Vaidya, who is the head of Treasury and Markets at DBS Bank, joining in. Lady and gentlemen, thanks very much for this quick call. Ashhish, if I could come to you, I remember when the JP Morgan announcement came in, I think the estimates were that anything between $20 to $25 billion can flow in with that inclusion. Now, how big is the Bloomberg inclusion and what could the fallout be?
Hi. I think important to understand that this is the Bloomberg Emerging Market Index. So this is a much smaller AUM under consideration. We expect roughly about 3 to 4 yards of money to come in because of this. The larger index is the global Bloomberg index, and market was speculating earlier that it'll be included as a part of the global index. If that was the case, then obviously the amounts would have been much larger. But all these are increments, and I think it's like everybody is looking at India and India bond market. So this is something that will continue over a period of time.
Ashish, hi, good afternoon. Lakshmi, hi, good afternoon. Ashish, you said $3 to $4 billion. What was that? I missed that.
Yeah, $3 to $4 billion. Yeah,
$3 to $4 billion.
Because and this is part of the EM bond index.
This is but the index global. Is the. Yeah, the bigger, it's called the Bloomberg Barclays Aggregate Index, right? The big one. And this is the EM part of it, is it?
Yeah, this is the EM part of it, is what I understand, yes. It's not the global index. If it was a global index, there's a larger AUM at
It's play. A much larger, yeah.
Yeah.
I remember, the larger index had some $2.5 trillion of assets under management. So that's even bigger than the JP Morgan one. But Lakshmi is also with us. Lakshmi, your first thoughts?
Yeah, so I, echo Ashish's view. This is the EM part of the Bloomberg index, where the total incremental amount will be roughly about $2.5–3 billion. The Bloomberg aggregate, where the total size is over $3 trillion. Probably this could be a baby step in the making. But yes, any form of inclusion is a welcome. When the announcement ab initio happened, the markets were speculating, as you rightly alluded to, it will be the larger index first. That would have actually shrunk the yields, bond yields, to as low as 7%, the moment the announcement came in today. But yeah, small steps are always a happy thing to be. And it also coincides at a time where, Indian currency is having a dream innings in terms of being the most stable currency across the world in the last 18 months. So I think all these ties up from a long to medium term perspective, it will still have a positive rub-off effect on bond yields. Which will get, only much more attractive from a foreign investor standpoint.
So, just a quick question to both of you. Since these inclusions will play out over the next couple of months, the Bloomberg one is in January of 25, and I think JP Morgan will happen sometime later this year. So that there is that happening at one end and liquidity coming in. And then we tie that in with, the expectation that second half of the year is perhaps the RBI will get a little more charitable with maybe a rate cut or maybe at least a more benevolent stance towards liquidity. So what does that mean for bond yield expectations, Lakshmi? Over the next couple of months, how would you expect the 10-year to behave?
So, yes, the positive spiel will continue, but bulk of the positive news is incrementally getting priced in, including the lower the fiscal deficit, tight and lower borrowing program. While inflation in India is not really so much of a bummer or a concern yet, I think the broader narrative will get tied around how soon is going to be Fed in a mood to cut rates, which doesn't seem to be any time soon looking at the data coming out of the U.S. So I think from a bond market rate cut gratification perspective, I think there is still some more time to expect a rate cut. But I think the hope of that, and let's not forget, FPIs have pumped in almost 40,000 crores in the last 2.5 months. That's a bigger positive than the impending rate cut to our mind.
Yeah. Since both of you are saying the expectation was for the inclusion in the global index and this is the EM index, Ashhish, in that sense, since markets move on incremental news, this is at the margin a bit of a negative? If the expectation being built in was it's going to be the bigger one?
No, I think at the margin, I think it's flat to positive. It sort of brings in certainty, right? That money is going to come in.
Okay.
I think important point, I think, like we mentioned, I think is very important that how the Fed behaves and how the Fed pivots. eventually what you have to look at is that Indian bonds will probably outperform other EM indexes. And I think that's going to be the reality, looking at the macros, looking at how much of supply is coming into India and how much of demand is going to be coming from the offshore FPIs.
Okay, all right. We'll leave it there for now, gentlemen. Ashhish and Lakshmi, thank you very much, both of you, for joining us and quickly sort of clarifying some of these points. And it's good to speak with you. Thank you. We'll take a quick commercial break here. We'll come back. Market, I think, is still there, about 30 points lower, 22,375. Stay with us.